Warren Buffett has beaten the stock market for 60 consecutive years using a strategy so simple it fits on a napkin. The question is not why Buffett succeeded. The question is why almost nobody actually does what he does.
And that question right there is worth more than every investment course you can buy.
We're going to answer it today.
The mission is to shine the light into the darkness.
Here's why we're starting the show with Warren Buffett. Not because he's the most exciting investor alive, he's really not, but because understanding how he thinks is the fastest way to understand how we think, and how we think determines every investment we make on our way home.
Berkshire Hathaway owns over 60 companies outright and holds significant equity positions in some of the most recognizable brands in America. It's been compounding investor capital at roughly 20% annually since 1965. That's not a good year. That's every year for 60 years.
Let's start with the number that stops everyone cold. $10,000 invested in Berkshire Hathaway in 1965 is worth roughly $400 million today. The S&P 500 over the same period, about $2.5 million. Buffett beat the market by a factor of 160.
Let's be precise about that. That's the compounding effect of roughly 20% annual returns versus roughly 10% annual returns over 60 years. Small differences in annual return compound into enormous differences over decades. That is the entire story of Warren Buffett in one sentence.
And here's what makes that number even more remarkable. Berkshire doesn't pay a dividend. Buffett has never split the stock to attract retail investors. He doesn't do earnings calls with flashy slides. The entire return is just the compounding of good businesses bought at fair prices.
Good businesses, fair prices, 4 words. That's the strategy. And yet,
almost nobody does it.
Studies consistently show that the average retail investor significantly underperforms the index. Index itself significantly underperforms Buffett, and Buffett has been telling people exactly how he does it in public letters every single year since 1965.
So the information has been free and available for 60 years and people still don't follow it?
Because the strategy is simple to understand and extremely difficult to execute.
And what makes it difficult to execute?
3 things specifically. First, patience. Buffett's average holding period is effectively forever. Most retail investors hold a stock for less than a year. Second, emotional discipline. Buffett bought more stocks during the 2008 financial crisis when everyone else was selling. Most people did the opposite. Third, fundamental valuation. Buffett only buys companies that have an intrinsic value. Most retail investors just buy the hot company.
So it's not a knowledge problem, it's a behavior problem.
Entirely. Charlie Munger, Buffett's partner for 50 years, once said that the secret to a long life and a prosperous one is to be not stupid rather than to be smart. Most investment mistakes are not made because people lack intelligence. They're made because people act on emotion, impatience, or fear.
It has almost no emotional response to short-term market moves.
He has described volatility as a feature, not a bug. When great businesses go on sale, he buys more. That is a genuinely unusual psychological profile.
The 2008 op-ed is the one that gets me every time. He published it in the New York Times at literally the worst moment of the financial crisis, while everyone was panicking, and said he was buying American stocks with his personal money.
And he was right. Anyone who followed that advice and bought an index fund in October 2008 tripled their money within 5 years.
So Bear, what do you think Buffett's approach means for our specific situation? Does the forever holding period strategy work when we have specific goals and specific deadline?
For me, I still think it works if we're investing in the right stocks. I know for us, we're being pretty aggressive with tech stocks. We're investing on the future. We're investing in companies that are involved with AI, with gaming, with tech and self-driving cars and the way we see the future going. So we're not looking to jump in and out of a stock, but we are aggressive with our positions and we're putting ourselves in a position where we can still fund our way home by just being patient, and those pops will happen when you're patient.
We talked about Buffett's strategy, and we're pretty much taking his strategy of being patient and keeping a level head throughout the market's ups and downs. So emotional discipline, as well as fundamental valuation. Even though we're investing in high growth tech companies, we're buying companies that are mostly profitable. There's a few kind of moonshot companies we have, but again, we have this goal that we need to reach. So we can't be investing like some 93-year-old man and we're investing with a little bit more urgency. But I think we're still taking his fundamental principles and applying them to tech stocks, which is something he never did. He never invested in hot tech stocks. So imagine how much better he could have done had he done that.
Yeah, no, I agree. And with that being said, what does this mean for Berkshire Hathaway as an investment right now? Not as a historical study, as a decision you can make today.
Let's hear your verdict. Go.
All right, so 3 things to know. First, Berkshire is currently trading at approximately 1.5 times book value, which is roughly in line with its historical average. It's not cheap, but it's not expensive. Second, Berkshire's cash positions recently exceeded 160 billion. Buffett has been selling positions and accumulating cash at a rate that suggests he finds very little at a fair price right now. That is either a warning about market valuations or an opportunity building for something large. Third, the AI era question is real. Berkshire has almost no AI exposure. Whether that's a strength or a weakness depends entirely on whether you think we're in the AI cycle.
So what do you actually do with it?
If you understand what you own, a collection of durable businesses run by the best capital allocator in history, you hold it. If you're buying it, hoping it moves like Nvidia, you don't understand what you own.
So we've been talking about Buffett's entire investing career and how he's outperformed the market so much over the past 60 years. But over the past 5-10 years, he hasn't outperformed the market by that much. He hasn't actually even outperformed the market. The S&P 500 has beaten him. And there is a very specific reason for that. And it's because he's not invested in technology stocks. He only owns Apple, and he might have bought a little bit of Amazon. But the point is, he has underperformed the market because technology has dominated the market and he has missed out on that. So when you talk about, would you want to own Berkshire Hathaway? Of course, it's probably going to do well because you own a bunch of businesses that are fundamentally, they're profitable and all of these things, but they're not the next Nvidia. Then he doesn't own any company that could be the next Nvidia or the next, Google or whatever. So will Berkshire continue to outperform, especially now that Buffett has stepped down? Will Berkshire continue to outperform over the next decade? I think that's a really tough question.
Yeah, I mean, I don't know what'll happen with Berkshire, but I just really like Buffett's strategy of not worrying about when to enter a stock. He's just all about buying a good company. And I think we embody that too. Like, of course, we definitely want to try to get in, if we can buy at the dip, that's great. We want to try in to get at a good time, but it's about getting in at a good company and being patient. So even if we buy it and it ends up being the wrong time, if we're buying the right company, we can be confident that we're going to get our money back with some time. And as far as how Berkshire will do, I don't know. Only the future will tell. We'll see.
I do think that his method is fundamentally solid. So Berkshire is not going to do poorly. They're not going to, go down a lot in stock price or anything, but will they outperform the market? That's, only the future will tell, like you said. If this episode made you think differently about patience as an investment strategy, subscribe. Every 2 weeks, we go this deep on a company that connects to our mission. Next episode drops April 20th. And remember,
this is all just for stocks and giggles.